Hello, everyone. Welcome back to part two of our discussion, chapter 6. We're getting to get into depreciation. So, depreciation is the idea that we had a cost, but it wasn't ordinary. So, it couldn't be expense because it was a big enough item that's going to last more than a year. And so the rules say now we have to apply a different concept of expense, and that is that we bought it in 1 year and we expense it over time, calculating depreciation, and that it lowers, and we record that each year on the Schedule C as an expense, but it could last for a while because it wasn't ordinary. It wasn't something you have to do all the time. You don't have to buy a building every year, or you hope not, at least. So, when you do that, there's some rules that the IRS has set up to calculating depreciation so that you know how much to record as an expense. And you need to know some information. Basis is the first one. That's usually the cost, but it can be something different than what you actually paid for it. There's a time period, how long it's supposed to last. And rather than letting you choose what that is based on the asset, pretty much the IRS dictates what that class life is. A convention, and we'll dig into that a little bit more, basically concept of half year or not. And we always use the half year convention unless we are required to use mid-quarter or mid-month. So again, it is specified in the rules. You don't get to choose very many of these things. And then the method. How do you calculate the depreciation? For the most part, we're not going to worry about formulas for calculating depreciation like we did in our early other accounting classes. We're going to let the IRS do it for us and show us in what we call depreciation tables. These are all part of reporting on your Schedule C, so you can have a business run for profit that has depreciation. You can have a rental property, which we'll learn in a later chapter, that will have to calculate depreciation, Schedule E, or a farm, which we really don't get into in this class, because for the most part it operates pretty much the same as a Schedule C. So it's not worth separating out. All of those could have depreciation. So what you don't have here is if an asset is not used for rental income or for a business, then you don't get a deduction for depreciation. Has to be used in one of those two. So, where is the situation where we would have basis other than what we paid for the asset? Well, let's say we start a business, and instead of buying a new asset, we convert an asset we are already using personally to business. Does that mean that we are out of luck in terms of having depreciation? And the answer is no. We can still have basis, but it is the lesser of the fair market value at conversion or the cost of the asset when it was originally purchased. Okay? If you got an asset with a non-taxable exchange, then your basis is the cost less any deferred gain. That's kind of complicated. We'll get into non-taxable exchanges in a later chapter a little bit more. So don't worry too much about that. If you're inherited, well, if we inherit an asset that we're going to use in our business, calculate depreciation, and we're going to use as basis the fair market value at the date of death. All right? So, examples. First one is the most probably likely type of example. Purchased a laptop computer for personal use last year for $2,200. This year, we started our own business, and now we're using the computer in our business legitimately, okay? Not just making stuff up. At the time of transfer, the computer is no longer worth $2,200 because laptops go down in value considerably. What is the depreciable basis in a computer? $1,300, the value at transfer. How do we handle these calculations? We purchase a van for $22,000 and we use it in our business 100%. If we have assets that are partially used in business, we really treat it as two assets, the personal part and the business part, based on the percentage we use it. And we just do it that way, with the business asset being the part that's used for business, and just treat it as if it's a completely separate asset. That's usually the easiest way to think about it and calculate it. Okay, but this one is all used 100%. Deducted $4,400 in depreciation related to the van. Okay, adjusted basis is the difference between what our basis was and how much depreciation we've deducted. So $22,000 minus $4,400, $17,600. All right, these are the depreciation periods. Remember, I told you there's not a lot of choices in this. You can't just pick a number that you think the asset is going to last. 3 years, specialized tools, racehorses, cars, trucks, computers, or 5-year property. 7 years for furniture, fixtures, equipment. Most everything falls in the 7-year category. Residential real property, 27 and a half years. Non-residential, 39 years. End of discussion. There's really not a lot of wiggle room. Okay, so auto use and trade of business, 5 years. Apartment complex, residential, people live in it, 27 and a half years. Okay. It can get a little bit tricky when you have a building that's used for both commercial and residential. You're starting to get into percentages. Treat it like two different assets. One that asset that's residential, 27 and a half years, is the second one that's 39 years. Warehouse, 39 years because it's non. Assuming it all in warehouse, none of it is used for someone to live in, then it is commercial or non-residential, 39 years. Okay, so not overly difficult to figure out where an asset fits in those time periods. Now, the monkey wrench here is these conventions. The normal situation is half-year convention, which means basically to simplify our lives, we're going to treat all the assets as if they get 1/2 year of depreciation in the first year that they are bought and 1/2 year of depreciation in the last year they're owned or the year that they're sold or disposed of. That's the general rule. Okay? all real estate has to use the mid-month convention. So your residential real estate, the 27.5-year property, and your 39-year property have to use mid-month. Doesn't matter. Anything else after that, it's half year does not apply to those. Mid-quarter is the weird one because it is required if you buy too much of your assets at the end of the year. So if you buy more than 40% of your assets in the fourth quarter of the year, then the IRS is saying you are taking advantage of the half-year convention, because half-year convention just takes a half year in the first year, assuming that you buy your assets, some in the first part of the year, some in the last part of the year, and therefore it all evens out. They're saying if you buy too much of your assets in the last quarter of the year, then you're trying to cheat. And so we're going to catch you and make you use the mid-quarter convention for all those types of assets. Still doesn't apply to anything real estate. It would be only non-real estate assets. So that would be the mid-quarter convention, which basically treats each asset as if it was bought in the middle of the quarter. So anything bought from January, February, March would be treated as if it was bought on February 15th. Fortunately, when the IRS did the tables, they weighed up tables that cover the mid-quarter convention, making our life relatively straightforward as long as we can identify which table to use. Okay? So, some check ourselves. Can you choose any depreciation convention? No way. Okay? You have to use the half year unless required to by buying too many assets. Then you use the mid-quarter. Unless it's real estate, and then it's always mid-month. Okay? We got the exception there, number 2. And obviously, half year is the most common, assuming that you're buying things other than real estate. Okay? You don't use the half year for an apartment complex. It's a real estate, so it is mid-month. Okay? And you must use the same convention in the year you bought it as you do in the year you get rid of it. Okay, and then our calculations, we use double declining balance that switches a straight line, 150% declining balance rating switch line, and straight line. Straight line for all real estate. The hard ones are the non-real estate, 200%. But guess what? We're going to use tables. Okay? And then we don't have to worry about our formulas. So the IRS prefers that. They think they've done you a great big favor, and they don't have to deal with calculation errors as much. So this is how those work. Here's your table. Okay, this is in the IRS publications. They provide this. You figure out what your asset fits in. Okay, and we haven't even talked about 10 or 15 because it's very few things that go in there. But 5-year property is very common. Car. So if you buy a car, you know what the cost is. And so you just take the cost or the basis and you multiply it by the percentage based on what year you own it. So since in the first year you own it, you go to year 1 and you take the cost and multiply it by 20%. In the second year you own it, you go to year 2 and multiply by 32%. Third year, 19.2. Fourth year, 11.5. Fifth year, 11.5. It switched over to straight line. We don't care because we're not worried about it. It's all for. And in year 6, why is there 6? It's 5-year property because half year in year 1, half year in year 6. This works for everything unless you sell it early. If you sell it in year 3, you calculate the depreciation using the percentage, and then you have to divide by 2. The divide by 2 to get the half-year convention is built in on the purchase year, but not in the sales year. Okay, how would you do a 7-year property? Take the costs. Year 1, you multiply by 14.29%. Year 2, 24.49, and so forth. Remember, I told you this is half-year convention. This is everything unless you bought too many assets in the last quarter of the year. Then you have to apply the tables that are for the mid-quarter convention. And there's 4 of these. Okay? Mid-quarter convention, placed in service in first quarter. There's another one placed in service in second quarter. All assets that you bought from January through March, you use this table. April, May, and June, you use placed in the second quarter. And the third quarter and fourth quarter. You see much more work only because they think you're trying to cheat because you bought too many assets. All right, so example. Bought a piece of equipment, $12,000, May 3rd, 2024. Only asset they bought. What is the depreciation for this equipment? Okay, go up to the table. Take the 12,000, you multiply it by 0.1429 in this year, because we're doing 2024, first year, and the depreciation amount is 1715, rounded. Now, a little more complicated. What if we sold it in 2026? Okay? So for 2026, that's the third year. We bought it in 2024. 2025 would be year 2. Year 3, we would use the 1749 multiplied by the 12,000. These are all multiplied by the same amount, the cost, the original 12,000. Okay? So if you were to check, these all add up to 100%, right? Okay, so by end of the 7 years, you've depreciated 100%. But in this case, you sold it early, so you'd have to figure it out by multiplying by that and then dividing by 2, which you did not have to do when you purchased it because already considered in our table, but not in the year's sale. Okay? Now, this example, there are tables that do 27.5-year property, 39-year property. But in my opinion, it's just easier to do the calculation. So in this case, you take the 330,000. You divide by 27.5. That gives you depreciation for a year. But to apply the mid-month convention, which is what you have to do for every real estate purchase, you then divide by 12 and multiply by 9.5. It's always a half. It's never 10. It's never 9. It's 9.5. Anything in March is 9.5. Anything in April, 8.5. Anything in, and so forth. Everything in January is 11.5. That's what the half-month convention, mid-month convention means. We treat it, even though it was bought on March 5th, as if it was bought on March 15th, half of a month. You will get that answer of 9,500 when you make that calculation that way. Now, Congress believes that by giving people extra special depreciation rules, meaning extra depreciation, they'll buy more equipment to get more deductions. Therefore, while we just went over how normal depreciation works, there are lots of things that are not normal about depreciation. One of them is Section 179. This is a situation where if we buy equipment This doesn't apply to real estate, no form of real estate. It applies when you buy up to $1,220,000 of equipment. You can elect to deduct it all in the first year. So you don't have to calculate each year. And once you depreciate it all in year one, you don't have any depreciation deduction in year two. So that's the downside. This cannot create a loss, meaning you cannot have more deduction than you have income from your business. So that's the downside as well. So applies to new assets when you purchase them, gets you this extra bonus or special depreciation. Don't call it bonus because we have a separate bonus depreciation. This Section 179 expense based on the IRS code section that it's found, the rules are found in, if you need to look it up. So, it's an example. Okay? If we had bought the equipment we bought in the earlier example for $12,000 in 2024 and chose to use Section 179 because we had substantial income, we don't have to worry about creating a loss or not. Okay? We would take all $12,000 in year one as Section 179 expense, and there would be no makers or no regular depreciation calculated. Not in year one, not in year two, not in any other year. However, what if the total equipment you purchased had cost $1,285,000? Now they run up against the limit on Section 179 expense, which is $1,220,000. So the other $65,000, we would then go back to the tables using the 7-year column, multiply it by the number there to find out what the depreciation is, the additional regular depreciation. In year two, we would continue to use the $65,000, just that part, to calculate depreciation, just like if we had bought it, an asset and not used the Section 179. All right. Now, of course, there's even another special depreciation, if you will. In 2024, as long as it has a lower life, less than 20 years, so again, does not apply to real estate, because that's either 27 and a half years or 39 years. Bonus is 60% of what you pay for it. No limit. Okay, so this is very beneficial. Now fits for new assets. Again, the stuff that you bought in the current year. So you have to buy it. So if we bought that $12,000 piece of equipment, then we could depreciate 60% of it using this bonus depreciation. That would be 60% or $7,200. And then the other $4,800, we would use our tables, calculate regular depreciation on top of that in year one. And year two, we would just use the leftover after we take the bonus to continue to calculate for year two, year three, and so forth. This can create a loss as well. This can be reduced. It can be enough with other expenses can make it so that we have a loss in our business. So that's the advantage of this over Section 179 and the fact that there's no maximum. So usually this is preferable. except for it's only 60%. And it will go down next year 40%, 10 to 20%, and go away unless there's a change in the law. Now, this sounds almost too good to be true, and so, of course, there are some limits. One of them is what's called listed property. These are assets that have a very clear business or personal use component. A dump truck doesn't have a personal use component to it, so it's not a listed property. But an automobile does. Boats can be business property, but you can clearly see how that could be misused or taken advantage of when you buy a boat that's mostly used for personal use, and then develop as some kind of fishing business in order to make it a deduction. So those types of assets have to be listed separately when we calculate depreciation. We have to give the IRS a lot more detail about what they are, what they cost, how we use them, than regular assets. Therefore, they're called listed property. Some of the restrictions are you cannot use Section 179 if the property is used less than 50% for business. So remember, we said you can have business and personal use and just treat it as two separate assets. But for these types of assets, you can't use Section 179 if it's below 50%. And if it is lower than 50%, no tables. Can't use the calculation tables that we used before. Have to use just a straight line depreciation calculation. This carries over to some limitations having to do with cars. Autos less than 6,000 pounds rated. The maximum depreciation you can have in year one, even with a bonus, is $20,400. No matter how much that car costs you, no matter how you would calculate using the tables, the depreciation, the maximum it could be is $20,400, then $19,800, and then $11,900, and then every year after that $7,160 for as long as you have that asset or that auto. So you buy a Maserati for $350,000. Your appreciation in the year one is still going to be $20,400. And year two, $19,800. Okay? So it doesn't matter that if we calculated depreciation on it, it would be much higher than that. That's the limit. There's also a limit on Section 179 for SUVs greater than 6,000 pounds. So a big Tahoe or Silverado or something like that might be more than 6,000 pounds. But it's still $30,500. It's still not $1,220,000 like it was for other types of assets. So there's still a significant limitation. So if we bought a Ford Expedition more than 6,000 pounds, they specify for $39,000. If we use the Section 179 and no bonus, we take Section 179 of $30,500. The other $8,500 we calculate using the tables. The tables for a 5-year property show a 0.2 or 20% for year one. So that other 8,500 times 0.2 gives us 1,700. Add that to the 30,500, and 32.2 is the depreciation on this Ford Expedition. If it was only used 80%, we treat it as two separate assets. We're only calculating depreciation on 80% or 80% of the 39,000. We would then use the 80% of the 30,500, right? And then we would calculate using the 20% on the table on the other part of the asset up to 80%. So we get 25,760. Now, a couple of people thought, well, we'll get around some of these maximums, these limits, by leasing very expensive vehicles instead of buying them. So we'll lease that Maserati. But the IRS said, no, that's not going to work either. We're going to limit how much your lease payment is deductible by making you add back some of it as an expense if your car costs so much. So that's not going to work. It's not going to, I mean, it works. There's still a deduction, but you're not going to be able to have an unlimited amount of lease vehicle deduction. There's still going to be an issue if it's the vehicle is really expensive. That's our discussion of depreciation. There's some additional kind of examples in a spreadsheet as well. You probably can't get enough practice. There's enough ins and outs to depreciation, but that's the most important points.